Okay. So good afternoon, everyone, and thank you for joining today's forum. Retention and the conversion rate models are gaining more and more importance in the insurance sector. And on a technical level, behavioral models predict a policyholder's estimated probability to renew or to buy a policy. And that's today, Gilly and Thibaut are going to share with us their view on modeling such aspects and reflect how the respective models interact with our usual pricing models, projecting the cost of claims. Gilly Smadja is a pricing consultant at Munich Re's Global Consulting Unit. Based in South Africa, he has gained in-company and consulting experience in risk and demand-based pricing over the past 9 years, working with local and UK-based companies. Gilly is a regular presenter on pricing topics to the actuarial community. Thibaut Humbert is a senior insurance solutions manager at Munich Re. He previously worked at AXA for 8 years, where he held several positions focused on risk management and pricing before joining Munich Re as an actuarial consultant. Thibaut holds a Master in Science in Applied Mathematics from École des Mines de Saint-Étienne. As usual with Zoom, you may already ask your questions during the presentation in the Q&A section at the bottom of your Zoom window. We'll have about 15 minutes at the end of the presentation to address them. Now, Gilly and Thibaut, the floor is yours.
Thanks, Valérie. So, as mentioned by Valérie, the idea today is to discuss about behavioral pricing and how to behavioral modeling and how to implement this into insurance pricing. So before starting, just a brief introduction in terms of agenda. So the idea is first to basically introduce what Gilly and myself are doing. So as we're a member of the Global Consulting Unit, so very briefly. Then Gilly will discuss about today's insurance landscape and how do pricing teams respond. So setting up the scenes in this regard and how the overall insurance ecosystem, I would say. Then we will focus a bit more on behavioral pricing per se. So addressing the different topic previously mentioned, conversion, retention, what to do with it, how to implement it. And then the last point will be focused on organizational change management. So in a sense on how to implement this and how within the organization and how to create value for the organization. So very briefly, as I mentioned, Gilly and myself, so working for Munich Re and are part of the Global Consulting Unit. So it's basically a division within Munich Re, fairly global. So of course, based in Munich, but also with offices in Johannesburg, Singapore, Sydney, and Beijing. And the purpose is to support Munich Re clients on primary insurance related topics. So that's why Gilly, myself, we have primary insurance background. So really supporting them on their daily operations on their primary insurance topic. How we are doing this is basically centered around 2 pillars. So one would be risk advisory and the second one, portfolio performance. So risk advisory, we talk about underwriting, product development, new development of new channel, strategies as well. So as you can see, and portfolio performance may be a bit more technical, talking about risk modeling, pricing, monitoring, all of these aspects. So really trying to cover all of the value chain, so from the ideation until the claims, going through also product development, pricing, the data analytics sphere is also covered. So this is how our consulting model work and what are the 2 pillars, I would say, of the Global Consulting Unit. So now I think let's start more and enter more into details into the topic itself. So I'm going to hand it over to Gilly, who will talk about today's insurance landscape.
Thanks, Thibaut. and thanks everyone for joining. So by way of introduction, I'd like to describe to you, I guess, the typical competitive landscape of an insurance market. And by way of example, I think we'll speak to personal lines, motor insurance. I see the slide on isn't changing. There we go. And the way I like to think about this is as an ocean. And in this ocean, there's a school of fish, which represents the policyholders. In Singapore, there's about 1 million vehicles, insured vehicles on the road. In most private markets, personal lines, motor, excuse me, they've experienced 0% growth after inflation. So which means this represents the full universe of policies from which different insurers can fish for new customers. Now, in this ocean, there's many different types of insurers. The first would be your large insurers represented by the whale. They've typically been around for a long time. They've got very well established distribution networks, normally intermediated. The downside is that they normally have legacy systems. Because they're intermediated, they often don't have full control over the rates. And claims management is usually via binder agreements, which means that it's outsourced and the insurers don't typically have control of that as well. Next, in this ocean, fishing for customers is your direct to consumer insurers represented by the dolphins. They sell directly, and as a result, they replace the agent commissions with large marketing budgets. They're built normally with a data-driven, systems-driven approach, and normally have strength in underwriting and pricing. And because they sell directly, they usually have their strengths in sales, and they retain it as well, sales, policy administration, and their claims functions. And next, we've got our fintechs. They usually, let's say, good at carving out a niche, so serving a particular niche of customers, and then become experts at selling to that group of customers. And then finally, we have our online aggregators, but I think in that pool, we can put, in that category, we can put banks, retailers, so everyone who's not typically an insurance carrier, insurance underwriter, but who is attracted to the insurance space and therefore is offering insurance products. And because they're marketing to policyholders, so they're going to try to take away business from the other insurers who are looking for business. Now, the result of this feeding frenzy, if you want to call it, is that you have more and more insurers throwing larger sums of money in attracting the same insurable population, which means higher acquisition costs, marketing, advertising, and higher new business discounting. So at new business stage, insurers need to provide larger discounts to attract the policyholder. And that results in higher churn rates because the policy will stay on the book, but will leave to drop off and take a policy from a competing insurer. Now, there's many solutions, I'll say, that are out there coming from across the insurance vertical, whether that's collections and retentions, whether that's marketing, becoming more efficient in marketing spend. So there's, I think, a lot of solutions, but pricing actually has, I'd say, one tool in the toolbox which can use to solve this problem, and that's behavioral pricing. So what is behavioral pricing? And there's 4 pillars, which we'll talk to each one at a time, if you don't mind. So the first would be you optimize your conversions using competitive market data. So always pricing relative to the market will ensure that an insurer is always competitive. All right, so the policy being sold is always in relation to the market, and that's at new business stage and renewal business. So at renewal business, we can assess what the market's doing at new business stage in terms of premiums, and the insurer can remain competitive. The next is to reduce churn. So even if we bring a policy on that's uncompetitive, if we can keep the policy on the books for a longer period of time, means that the policy will become profitable eventually. The third method is upselling or cross-selling. So once a policy comes on book, we've already incurred the acquisition costs. I hope you can all hear me still. And then any additional policies or add-ons, cross-selling, upselling, which we sell on top of that, will come at no additional or very small additional acquisition cost, which means that we can enhance the profitability by adding more products. It also happens that policyholders which have more than one product likely to stick around on the books for longer compared to a monoline or a policyholder which only has one product. And if we can bring those three things together, so being competitive relative to the market, reducing churn, upselling and cross-selling, and we can consider all of those from the perspective of each individual policyholder, and then in turn as a portfolio as a whole. So we can build a expected, let's say, profit expectation from each policy, and we can use that to price. And that's what we call customer lifetime value and then price optimization. And we'll speak to each of these as the presentation progresses. Now moving along. So I thought it'd be useful if we just spend a few minutes speaking about premium build up from first principles. It will allow us to define some key concepts and also to limit the scope of our discussion to the area where behavioral pricing is relevant. So, and as everyone knows, the biggest component of a premium is the burning cost or the risk cost or the claims cost. It's expected cost of claims for the exposure, excuse me. It's typically made up of frequency, so claims frequency and claim severity likelihoods, which are then aggregated together, across coverages, across products, across perils, to come to an overall burning cost. Typically, 60% or 70%, whatever that is, of the premium. So that would be the loss ratio. And because it's, I'd say, the largest component, the most important, and I think it's by definition, it's got an expected element to it. So that's where actually pricing actually usually spend most of the time modeling what this claims cost will be. If you talk about an actual pricing team, I think by most likely we're speaking about a risk cost pricing, which would be looking at this element of the premium. And next we have our direct expenses, which would be the cost of bringing on an additional policy. So things like performance fees on an aggregator, claims handling fees, and they could be loaded as a flat quantum amount or as a percentage of the burning cost. Next, we have our indirect expenses, and these would be any costs incurred irrespective of if a new policy is added to the books or not. So there is a bit of overlap, I'll say, with direct expenses. The bigger the book, let's say, the more claim staff you'll need. But it's not that we're going to add on an additional claims manager for every additional policy we sell, right? It's so as the book grows, then we decide we need some more claims management. So the costs will be incurred irrespective, most likely, of the size of the book. So typically, we'd want to allocate these expenses to have the smallest impact on premium. So we wouldn't want to allocate expenses such that the premium becomes uncompetitive. So insurers typically will allocate expenses as a percentage of sum insured or percentage of risk cost, such that if you're paying a small risk, you're paying less towards expenses. And if you're paying more risk or a larger sum insured, so you'll normally pay more towards your expenses. The sum of these two, direct and indirect expenses, is 25%. So still a significant part of the premium, right? So I'll say, while there's no expected element to this, like a risk cost, still I think it's important then that pricing teams do spend time thinking about at least how to allocate the expenses such that expenses are all collected, so the insurer doesn't run unprofitably, but at the same time that the correct policies are paying towards the expenses. And then finally we have our profit ratio, which is, I'd say, the reason that most insurers are in business. Now, a prudent insurer, I'd say, would not want to sell a policy less than that they don't recover the claims cost as well as the direct expenses, so the cost of bringing on that additional policy. I think that's prudent. In many markets, it's not accessible. Actually, you need to be discounting more than that. But for the purpose of this discussion, we'll define that as our minimum new business premium. So it would be the loss ratio, the claims cost plus the direct expenses, which makes up about 80% of the premium. And then, the whole stack, considering everything we've spoken about together, would make the technical premium. And it's this area between minimum new business premium and technical premium, which most likely we're going to be playing with. So when we talk about behavioral modeling, which Thibaut is going to do in another second or two, and we talk about price optimization, it's really this element of the premium, these two components, which is flexible, which we talking about loading or discounting. I think that's will give a good introduction to the topic, but I think let me hand over to Thibaut to dive into the meat of the presentation. Thank you.
Thanks, thanks, Gilly. So now let's focus a bit more into behavioral pricing. So first, let's set up a bit, so in the continuation of what Gilly said on what we call the behavioral modeling flow. So let's start from the quote, see the life of the policy and where the different models, so modeling type can intervene, I would say. So we start with a quote. Of course, this quote can be declined or accepted. And in this case, we talk about another written policies. This policy will continue, usually for 1 year. So let's say we have a 1-year policy, so it's still in force for 1 year. Then after 1 year, either it is renewed, we talk about retention, or churn in the case it is lapsed. So the client decides not to continue, maybe to switch to another provider, to stop, many reasons. So this is the life of a policy and then can continue over many years. What we can also do is the client has, for example, one motor policy, and we can try to cross-sell, meaning selling, for example, personal accident policy, house, homeowner, household insurance policy, this thing. So here, and this is along the whole process that we have the different steps and aspects of the behavioral modeling. So starting with conversion, so it's really the probability to convert, to model the probability, that likelihood that the potential client will convert into a client. We also have sometimes midterm cancellation models, so the probability of canceling midterm, assuming this is possible, assuming there are enough data. From what we see and what we saw on different markets, this is not usually something that we see often. So really, then after 1 year, so let's say we arrive at expiry of the period, retention modeling, of course. So the client paid, I don't know, 100 the first year. There is a proposal made, also based on the claims history of the client throughout the year, and potential to convert, to retain the client, yes or no. And this is usually here that we see most of the models being done, because also what we see is much cheaper and efficient to retain a client than to try to acquire a new one. So the focus is usually here, and also from a data perspective, it's easier to get the data also in the database and to process the data. And then a bit on the side, so here it's linked but could be parked also, is cross-selling, so trying to really sell over product. So here there are two components: to which client should we try to sell which product, and also at which moment. So it's also part of the thing. Usually we focus on which client, which product should be offered to which client. So here I would say the 4 aspects in terms of behavioral modeling. So let's move to the next slide. The next slide is simply, so okay, first we're going to focus on conversion. So as I expressed, the idea is really to be capable to, based on quote database, to predict the probability of a client with a certain profile to convert. So here we mentioned a few things. So machine learning traditional GLM work pretty well. Also, of course, machine learning technique, what we see tend to be a bit more used, not more used, let's say, in this context than when it comes from risk modeling, because we have a bit more flexibility, less need for explainability. So that's why we also have random forest, gradient boosting, and all of the possible machine learning techniques. And something that I also mentioned, AutoML, which is something at Munich Re that we use quite a bit. We try to combine machine learning with the GLM aspect to really keep the interpretability and be capable to really explore from a data perspective the scope, the space of the possible model. So these are basically the idea. So here it's a bit the same. So we talk about conversion rate or retention rate, and just summarizes what I was discussing before. So the idea is really to be capable to assess, to also understand how the demand evolves in regards to the price. So also this, we will talk about it a bit later into detail. And then, so of course, deploy the results, because there's the modeling part, but never underestimating the deployment, what I personally tend to call deployment and execution. So being capable to transform all of this into business value, actionable insights. And here on the right part, also we also mentioned the different techniques, same as previously. So logistic regression models, I would say, or machine learning techniques. These are more or less the two main ways of doing it. So now, if we really focus more on conversion, here is simply what we do and some of the way we use it. So quote, proposal, contract. So it's really being what we try to monitor is really in the end the quote to contract, because this is how I have my client, my potential client entering what is the ratio of finally converting it to a contract, but we also can decompose it on quoting up to the point of stopping in the middle, or maybe getting a proposal and then converting. Decomposing helps, and these are things that we have seen, helps us into how to say, help us to understand where the client can drop. Is it a price question? Is it a customer experience problem that, for example, there is a quote which is not stopped, this kind of things. So this is a bit the idea. So before moving further, what I would propose is to have a quick poll now that we have set up the different the context, the different term, just for us to understand a bit more where you stand in terms of a behavioral model in your stream. Let's take 1 minute, maybe time to. Can we, I think we can maybe visualize the results. Okay, so that's pretty clear. Yes, that it's still something not yet fully implemented. So we see that there is some people use it for conversion, retention, or for both, but also majority of the people are not using them. I would say it's also, this is also what we see while discussing with clients, that this is something that people, there is awareness in this regard, but it's not necessarily yet implemented. Sometimes it's a question of resources, sometimes it's also a question of data. So these are things that are usually taking time. It really depends on the channel is also important. So for example, conversion that we just discussed would be more on the intermediated channels. So that's pretty clear. So we talked about conversion. So very briefly on why we are monitoring the conversion rate is really for us to understand that we are relevant in terms of product pricing to the market, make sure that we may be too expensive or not enough. Also, this is something that is usually a good indicator. Speaking for myself, I have done it previously, launching new products or launching a new product in a new market. without data or data from other markets, it's sometimes a bit complicated to get it right from a pure pricing perspective. So conversion is something that we use to make sure that we are in line, I would say. So assuming that the market is behaving normally, so let's assume that profitably, on the segment that I want to target, my conversion should be as per the plan. And if I see higher conversion, generally speaking, or usually what we see more specifically into some segments, here I may have to be careful and realize that I've been mispriced. Even if I say this, I experience it also the fact that yes, it's important, but we realize that it's really important because I can speak on some markets where some regions were known to have high conversion, but also high risk. And here we realized that there was really a pricing issue when we launched the thing. So we had to react and we didn't necessarily react fast enough. So this is the idea. The question is how to do it. How to do it is always kind of a challenge because at the same time, it has to be as automatized as possible because as mentioned, the conversion should be done ideally on a weekly basis. This is what we say to really monitor. Monthly seems a bit too wide in terms of frequency, not enough. So as automatized to really allow it, but also flexibility because it's important to be capable to deep dive, to drill through some specific segment, to visualize what is happening, to better understand, because sometimes it's not only one variable, so I know a young driver, but it's a set of variables defining a segment, young driver in the region with a specific type of vehicles. Or if we talk of household, it would be some big houses in a specific region, which may be prone to fraud, theft, I don't know, natural catastrophes, this kind of thing. So this is a bit the idea that conversion rate is important really to monitor because it really gives insight quickly and can really help us to understand the client, the business, all of these things and anticipate and be proactive, I have mentioned, to anticipate on potential market challenges. So now let's focus on retention. Retention is usually the first one which tend to be implemented because we have the database, we know of our client, we know which price they paid the previous year, what is our proposal, and we know at the end if the contract is being renewed or if or lapsed. And then there's potential to analyze. So from a technical perspective, it's more or less the same, but that's the idea. And now we're going to see why it is important to focus on retention. So usually we have this example. So we have Paul and Henry. Paul and Henry, they are two twins, so same age. They live in the same city, so they live in Munich, and they have the same car. So, and as at now, they pay the same premiums. So they pay 300 euros, and the renewal offer would be, because they have the same risk factors. So now the idea at renewal would be to apply a plus 10% lodging for both of them. So same risk, same strategy. The only difference is that Paul is a successful pop star while Henry is unemployed. So what will happen is that if we do this, Paul, being less price sensitive, price elastic, will probably renew. Henry, on the other way, will not renew. So here, they have the same risk detail. So we run on 70% loss ratio, let's assume, but earned premium will be 330 euros and a margin of 99 euros. So here they have the same offer. Now, if we study a bit more, we have not the same offer, but an adequate offer. Paul being a bit less, as I mentioned, price sensitive. In plus 15%, he will still renew his policy, while Henry, 10% were maybe a bit too much, but 5% is okay. And in this case, we double the earned premium under the same loss ratio, so profitability constraint in total, so 70% loss ratio, and we can easily double the margin. So this is the idea, and the idea is to move from the same offer to an adequate offer, taking into account some other factors of the client. So as previously I mentioned, we talk about I talked about price elasticity. So the idea is how to assess the elasticity. So here, modeling behavior, we know how to do it. But what we also want to do is to measure elasticity, which is how much does the demand evolve when the price evolves. The thing is, we don't have a variable, a target variable, when it comes to price elasticity to really predict this thing and have a prediction, direct prediction on the elasticity. So usually here, what we see and what we put in place, depending on what's feasible, are three possible methods. The best one, we tend to prefer is really randomized price test. So it's for a similar set of profiles. So people would pay same premium, applying randomized discount loading a bit. It may be plus 5%, -2%, this kind of thing. And then to really assess in an orthogonal way, I would say, the price elasticity. So here we take into account the risk details, the portfolio mix, and it's at the individual level. This is the best one, but has some constraints. So first, we need to have the capability to do it, which is not always the case, be it from an IT system, distribution system as well, regulation, because in some countries we know that it's not allowed. These kind of things are not allowed. So it's not always the easiest one to put in place. What can also be done is, I would say, something a bit more traditional, premium change curve. So assessing a bit the demand in regard to the price, to see how does it evolve. Does my demand evolve with my price? So this is the typical things that we see in economics, the curves when it comes to price to demand. Here, the only thing where we have to be careful is on the fact that this does not take into account the portfolio mix. Because if we sell, I don't know, bottles of Coke, we see the curve, but it's always the same thing. Here, the risk, they differ at different levels. So we have to be a bit more careful in this regard, but at least it gives an insight on how, if the elasticity is the same throughout the whole portfolio and at different levels of premium, yes or no. And then the third one is more in comparison to the market. So assessing, so by collecting market insights, assessing the elasticity and how do the clients, to the customer, behave in this regard, to see also that if a small change in premium, so if we are slightly more expensive or slightly cheaper than the market, triggers some changes in the conversion or the retention in this case. So let's just briefly recap. So here is really the traditional thing, and how we measure elasticity is simply the evolution of the demand when we change the demand and divided by the evolution of the price. So where we think it's important is that it really also allows us, and that's the bottom line, to assess the impact of price change and to be able to anticipate what will happen from volume perspective if I decide to increase my premium by X%. So here we can really assess what is the elasticity and how we can expect the book to shift, and then we can potentially anticipate. Now we will explain a bit more into detail when it comes to price optimization, how to combine all of this. Very briefly, upselling, cross-selling. So here the idea is really to, as I mentioned, to be capable to find what is the next best product to the client, what do we sell, and also at what time. Really trying to find at which moment where we are most likely to sell a product. So it's about customer interaction, customer engagement. So all of this also being done through same modeling techniques. And the idea is really here, it's I would say low-hanging fruit when it comes to increase the profitability also, and the profit per customer, because acquisition cost is fairly small. Really, we can really target directly. So for example, commission is wiped, so we have limited expenses, as Gilly mentioned. They tend maybe to fall more into the indirect thing, but pretty limited. There's also the relationship and trust. So we have a client more likely to and more likely to stay in the end. That's, I think, policy tenure, because clients with all of their policies in one company are always, it's known, reluctant to move from one company to another. So this is very briefly when it comes to upselling, cross-selling. So it requires some testing, data collection to be capable to find the best product and the best time and get the optimal strategy. So here we discussed about price conversion, retention, upselling, cross-selling. The idea is really maybe to combine all of this into a whole process. We know what's the probability of the client, the customer, to convert, to stay, and potentially to buy over products. So here we can potentially find what would be the best under a set of constraints, how to maximize a set of KPIs. So here, very briefly, the idea is really to define what we want to optimize from a technical perspective. Are we more top line driven, volume, loss ratio, bottom line, retention? Sometimes what we see also is the expected margin per policy, so what that we want to optimize. And so this is what we want to optimize. Usually this is being done under constraint, so strategic constraint. We don't necessarily want to shift totally our book from one type of customers, be it, for example, fairly experienced driver in certain region, to something totally different. Commercial also, we don't want to penalize too much some of the client, because it can also give bad reputation. And also important, and what we see is more and more important aspect, is the regulatory aspect, that we cannot do optimization the way we want, because regulation plays a fairly strong role in this aspect. So, and then what we try to do is to optimize, be it at the portfolio level generally, or at the policy level. Both can be done. I just want to have set of premium maximizing KPIs, the general KPIs, or for each and every policy, I also want to have the optimal one, and with some deviation. Very briefly, so here the idea is really to support and to take the best decision in the end. So we do all of this to really find the optimal strategy. So here is an example. So current status, we have an expected loss ratio 75%, retention at 85%. What we want to do, for example, at the beginning is, okay, I want to lower my loss ratio. Nice thing is I increase the average premium. Okay, my loss ratio will decrease, but my retention as well. So here we are more into improving the loss ratio. On the other hand, we can also do it on the other side. I want to increase my volume. So here we see that my expected retention will increase. So we will decrease the average premium, but the loss ratio will go up as well. So now it's if we optimize the premium, it's potentially capable to do both. And this is really what we want to do. Here, we managed to improve the loss ratio and the retention rate at the same time. So this is what optimization, price optimization allows us to do. But then it's giving us guidance. What is important is that the idea is to be capable to support the strategy and support the decide on the best strategy. So here, for example, what we see is there are these two scenarios. One is top line driven. The second line is bottom line driven. The optimization allows us to do so, but then where to go? Should we go towards 1, 2, or maybe 3 in between? This is something which has to be decided, I would say, at the strategic level. The algorithm cannot tell us what to do on it. The algorithm can only give us, so here we talk about the efficient frontier, what are the set of optimal combination allowing us to find the best thing, and then where we want to move along the optimal the efficient frontier. It's up to us, based on many considerations, to decide in this regard. So very briefly, so this is a quick example of this kind of thing, simulation that we run. So we see that the more we see, we are reaching this frontier, and then this will be up to us to decide where we want to be. So this is, I mainly mentioned things from automated way. So, but here it's how to integrate it into the business. So here we mention more from the technical part. Okay, we have our model, we run conversion, retention, potentially more, and then we optimize. Then comes also this thing that it's not because we optimize that it's necessarily the best, because the business considerations have to be taken into account in this regard. So do we go more into full price optimization in the bottom, best optimization, but we may lose control? So we have a set of premium, but we don't really know how they are being calculated. We had kind of a black box component because it's optimized. We have the premium, but that's it. Or more into scenario testing. Knowing all of this information, I will try to find the optimal strategy a bit more manually to reach my my goal. So I may not be fully optimized, but I keep the control. So this is the good thing. So partial optimization, but I control. So this is really something which has to be taken into account. So I think that's it for also being mindful of time for the behavioral part on it. Just before handing over to Gilly, a second poll very briefly, just to understand a bit on optimization, if we can. It's basically how you are using behavioral models, and this if you are using more price optimization or scenario testing for people, the few people who are using the behavioral modeling. I think we can have a look at the results very briefly. Let's see. Okay, so what we see is interesting. So, okay, no, beside the not use of behavioral model, which is a bit in line with the previous one, but scenario testing. So scenario testing is something that really compared to price optimization is used. And my personal experience is really what we see wherever the market is, that scenario testing is still core, and because it's really important to keep control on what we are doing. So now for the last section, I will hand it over to Gilly for organizational change management. To you, Gilly.
Thank you. Thanks, Thibaut. Just the last minute, I think, just to summarize. So the theory is all good and makes sense. And I think every organization would like to maximize profits while at the same time driving the highest conversion rates or retention rates. But it does, excuse me, there's the requirement for, I'd say, a corporate culture where pricing becomes, I'll say, not so back office driven, but very much front office alongside sales, marketing, policy administration. So how does this all come together? So what we're promoting is what we call the pricing and underwriting committee. So underwriting committee, I think, is pretty ubiquitous, but pricing committee where we can bring together various functions from across the business. And we'll start with IT. So IT will be responsible for pricing software, rating engines, policy administration, and making sure that each of those speak to one another. And the data stored and the data being provided for monitoring. Then in terms of the pricing team, so we best practice, I'll say, to split between two separate teams, the one being the technical price modeling team. So now we know in a typical risk pricing framework, there are quite a lot of models which need to be developed and updated. And that's, I'd say, even more so when it comes to behavioral modeling. So both from the development point of view, as well from the monitoring and upgrading the models, they do require more constant feedback loops, so more regular refreshing. So the technical pricing team will be responsible for the development, looking for new factors, refreshing the models, and then frontline pricing team would be looking at the price tests, what are prices doing relative to targets, how are margins reacting, how are loss ratios reacting, how are conversion rates reacting, and all of those in combination. And then changing the prices for each of the channels or brands or products in order to ensure that each of those are meeting their targets. And then sales and policy administration teams. So, I mean, like we've emphasized a few times, sales is a direct function of price. So, you know, as price goes up or price comes down, sales is going to be importantly influenced, and behavioral pricing obviously is trying to influence that result. So it's important that the sales team understands what the pricing team strategies are, and vice versa, that the pricing team realizes what the sales strategy is, and that the two are working in conjunction. And then finally, I'll say senior executive sponsor. I mean, bringing these functions together from across the organization is tricky enough, but to talk to each other in the same language on a regular basis, I'll say, is even more tricky. So I think it does require a sponsor from the top, someone who can stake their name, stake their reputation, and bring everyone together, you know, with the kind of responsibilities or the influence across the organization. And that comes together nicely monthly or more frequently in a pricing committee, where these topics are discussed, strategies planned and monitored, and similar topics discussed. So that does bring us to the end of the conversation. We've left about 15 minutes or so for some questions, which I see have been coming up in the Q&A. I don't know, Valerie, Liana, I'll hand over to you maybe to assist there.
Yeah, thank you. So I think, Jessica, you will be asking the questions from the audience.
Hello. Okay. So we have a first question that is, if we offer aggressive discount during acquisition, how do we reduce churn with less discount upon renewal? Dilly or Thibaut, would you like to take that?
I'm happy to take that one. Yeah, I'll take it. And then Thibaut, come in, obviously, if you have anything to add. So yeah, it's a challenge, right? So we want to give discounts up front to acquire the policy, but we can't bring the policy to profitability or to a technical rate at first renewal. So the approach is either to stagger the increases so that over time, whatever that target is, the policy reaches profitability. The other strategies would be, like we said, cross-selling or upselling, so that at a holding point of view, so not one policy, but all the clients' products, that there's profitability across all the products. I mean, and that's becoming a very popular approach in countries where, let's say, aggregators are dominant in terms of sales. So that would drive price down for the core policy, but then the additional policies, you know, the warranties and other policies being sold, breakdown covers and the like. So that's where the profitability will come from. So I'd say it's a combination of pricing, product, and the patience. Thibaut, do you have anything to add from your side?
No, I think patience also, so meaning that it's also a part of can be pretty aggressive, and then on the long term, so really finding the right level, even if it's not the one to cover the upfront discount, but maybe on several years. So this is the thing, and really it's too complicated. It's not an easy topic to balance.
Thank you. So the next question we have is, what are usually the key factors that are used to model the conversion probability?
I can reply this time, Gilly. Yeah, so I would say what I've seen is, I would say two things. First, the price, and particularly the positioning to the market. This is something that in the end drives. So the idea is ideally to have information to what is how much cheaper or more, what is my positioning on the market when it comes to this profile. So this is typically something all of the models, they see it. So it can be expressed in different ways. So we can have what is my rank. it's also proven sometimes that on price comparison website, it's a bit no one goes on the first page on Google. So it's a bit the same. No one scrolls after the fifth price on the price comparison website. So my rank or also my gap to my competitors, not necessarily the cheapest, but also here the players which are in the same sphere as myself. So am I an established brand, a digital player, this kind of thing. So this, I would say, is the first one. Second one is also more on the driver itself. So the client, more than the vehicle, is really the age, information on the socio-economic status, credit score can have an information, all of this information also, because they also have an impact on the elasticity and therefore on the probability to convert. So I would say these are the two things that personally I would highlight. Anything to add, Gilly? You?
Maybe I'll just one more sentence. Excuse me. What we show, I mean, with behavioral models, what we're trying to look at is what would attract a policyholder to buy the particular product. So, you know, like Atiba mentioned, competitiveness, price for such a commoditized product like insurance is your biggest driver, right? It's most likely going to come down to price. But things like affordability do make a big difference. That's why credit score, credit understanding, credit history is important. And then like a desire to buy. So what's the client's interest in buying? And you try to assess that in different ways. Channel normally is the biggest driver when it comes to interest to buy. I mean, think about someone who, let's say, searches a generic term insurance on Google and then clicks on the first two adverts that come up, as opposed to someone who Googles the particular brand they're looking for. So the intent of the client who's Googling a brand is obviously great to buy from that brand. Whereas someone who's just generally going on an aggregator or just Googling insurance quote for the type of vehicle they have is less attracted to one particular brand over another one. So if we can use information to try assess those likelihoods, that would be the best. But, you know, often it comes down to the data we've got, and insurance data is likely what's being collected. But I mean, often it's a good proxy for predicting conversion. You know, you think age, gender, marital status, location, they all happen to be very good proxies for predicting likelihood as well.
Thank you. Our next question is also about conversions. So would you usually use different levels of discounts to test out the probability of conversions?
So, I mean, I'll take this one if we're following the pattern. So yeah, so I mean, like Thibaut spoke quite in depth about, and I do see a question below about randomized price testing being required for modeling elasticity. So I'll just answer both of them at the same time. Yeah, so the point is that I think this question was actually asked before the price testing slide came up, but that's the point, right? So the best case is we try offer different levels of pricing, so discounting and loading, and we look at the conversion rates across the buckets. That's the best price. I mean, you know, if the systems allow for it, if the data allows for it, there's no too much opportunity cost by doing it, then you know, that's the makes the most sense. But at times, like Thibaut also explained, it's not possible. It's more challenging to implement. So then we'll look at the price curve, you know, which doesn't standardize the profiles. At the same time, we can look at the price relative to the market and how price changing as that price is flexed relative to the market premium. So then what happens to conversion rates? That does happen to be a very good method, but often collecting market information is more challenging. So like, for example, in South Africa, it's a very difficult task to understand a market premium per profile, whereas in the UK, let's say it's much easier. So I mean, in Singapore, I'm not sure what the case is. So, excuse me, I hope that answers the question.
Yeah, okay. So I think in the interest of time, this will be the questions we're answering. We hope we covered most of them. So I'll hand it over to Valerie.
Yeah, thank you. Thank you, Thibaut and Gili, for taking us through this presentation. And I guess we will try to answer the other questions later, actually, maybe when we post the slides of the presentation, we can add a slide with the answers to the questions. One last thing I would like to ask to our audience is to please give us a few minutes more to answer the feedback survey. We have a QR code which should be displayed here, yes, just on the screen. So please, yes, scan it and answer, and then it should be done for today. Thank you very much, and see you again soon for another forum.
Thank you.